Assalamu alaikum guys. In today's lecture I will try to elaborate the meaning of five accounting families that are the basis of every accounting course. Throughout your accounting course you will see these different accounting families, so you need to get a very clear idea about these different accounting families, as these are the basis of the accounting course. So I will try to explain each one of the accounting family step by step. So first of all, we have the assets. Assets are the economic resources which are owned by a business and are expected to benefit the future operations. The important thing over here is that all the resources which are in the possession of a business are not guaranteed to provide benefit in the future, but all those resources which are owned by a business and they are expected that there is a chance that they can provide future benefit will be treated as the assets. For example, we have building, land, raw materials, etc. These will be treated as assets if they are owned by a business and there is a chance that they can provide benefit in the future. Again, there is a, if we classify the assets, so generally we have two major types, that is the tangible assets and intangible assets. So those assets which have some physical existence, that we can touch them, we can see them, are known as the tangible assets. For example, truck, building, land, inventory, etc. On the other hand, there are some sort of assets that are owned by a business and are expected to provide the future benefits, but we are unable to see them or we are unable to touch them, that is they have no physical existence, like goodwill, patent, etc. So generally we have two major classifications, tangible assets and intangible assets. Besides the tangible and intangible assets, we have two further types. One are the current assets and the other are the fixed assets. Current assets and fixed assets. So current assets and fixed assets, those assets which can be converted into cash within a year or less than 1 year are treated as the current assets, while those assets which can be converted into cash into which takes more than 1 year are treated as the fixed assets. For example, if we want to sell out our truck, so it might get 1 month or 2 months to be sold, so it will be treated for example, if we have raw materials, we have the some other sort of the assets which can be easily converted into the cash, will be treated as the current assets, while those assets which can not easily be converted into the cash or which can benefit the business for a longer period of time, that is usually more than a year, are treated as the fixed assets. For example, building, land, machinery, everything is considered as a fixed assets because they benefit the business for more than 1 year. After the assets we have liabilities. So simply liabilities are the debts that business has taken loans from the creditors, that may be the banks, that may be the financial institutions, through the issuance of the bonds. So all those debts will be considered as the liabilities, and generally we have two sorts of liabilities. One is the current liabilities and the long-term liabilities. Those liabilities which usually mature in 1 year or less than 1 year are treated as current liabilities, while those liabilities which usually are matured in more than 1 year, that is to say which take more than 1 year to be repaid, are known as the long-term liabilities. After that we have the owner's equity. So simply the owner's equity represents the sources invented by the owners, that whatever in the form of the cash or non-cash items which are invented by the owners in a particular business will be treated as the owner's equity. For example, uh, if one partner has, for example, invented cash, the other might has contributed to building and land, so these will be treated as the owner's equity. These are the sources which are invented by the owners. After that, we have the revenues. So revenue basically represents the price of goods sold and services rendered to the customers. That whenever the goods are sold or the services are rendered to the customers, and in exchange of such goods sold or services rendered, we get some price, we get some money, and that will be treated as the revenue. But keep it in mind that not every receipt of cash is treated as a revenue. For example, if you take loan from the bank, it will not be treated as the revenue. The only those things can be treated as the revenue which increases our owner's equity. And the last item of these accounting families is the expenses. So the cost of goods and services used in the production process of obtaining revenues, that is simply that all those cost of the goods and services which have been used, which have been incurred in obtaining the revenues, that in order to obtain the revenue, in order to earn the revenue, all those cost of the goods and services which have been used will be treated as the expenses. Or sometimes it is also known as the expired cost, because the cost has been used, so therefore the expenses are also known as the expired cost. So this is some sort of brief introduction of the accounting families. In the next lecture, I will explain each accounting family with their complete detail, as well as their classification uh, as well.